Have you ever thought about funding a whole life insurance policy with a lump sum? You're interested in maximum cash value. You love the core benefits of the cash value being a safe, liquid, tax-free area to position money, but you do not like the idea of payments. If I could just throw a big pile of money in there, let it sit and grow, access it when I want, and I've got a death benefit with it, boy, would that be great. We get that a lot. Many times people ask the question, my dad is very interested in this kind of stuff, can I just throw a big pile of money in and be done with it forever? So the answer is yes, but there are some things we want to be aware of. What we're going to focus on in this video and the next several videos is lump sum policies. One, how do I maximize the cash value? What is the most efficient method to actually fund a policy? Because it is often not just a one-time lump sum payment. But then two, putting the money in use. So it's one thing to maximize the growth rate, the internal rate of return. A lot of people are interested in that. But then I've got a high yield savings asset. How do I actually use the money? If I want to borrow against it, invest in real estate, in my business, whatever it might be. So we're going to cover quite a bit in the next several videos. Let's have some fun. In this video, we are going to look at a 50-year-old individual with a $1 million lump sum. So he's interested in a whole life insurance policy for the core benefits. Primary focus is cash value, being a safe, liquid, tax-free area to position money. Now on the tax-free piece, he's interested in a non-MEC. So whenever we're looking at a lump sum policy, you do have the option to go with a modified endowment contract, which gives you a tax-free death benefit. The cash value growth is great, but we can't really access that cash value. We can, but we have to deal with taxes. We don't want that. So we've got a non-MEC policy, and the MEC limit is important to be aware of. We're going to touch on that as we go through this video in the next several studies, because when we look at lump sum funding scenarios, being aware of what that MEC limit is quite important. It's always important, but particularly with lump sum policies. So the specific question is this: can I make a one-time payment and be done with it? I love the idea of a whole life insurance policy, but I do not want ongoing payments. We get this quite a bit. Some people like the option to be able to continue to make payments if they want. However, a lot of people are attracted to the idea of funding a policy for a short period of time. So the answer to this question, can he make a one-time payment? Yes, but it's not always the most efficient strategy. So a question to ask yourself with a whole life insurance policy is, how long is the premium due? Most whole life insurance policies are titled Whole Life 100 or Whole Life 121. If you have a policy or see an illustration that reads Paid Up at 100 or Whole Life 100, what that represents is that the minimum premium piece is due up until the age of 100. Now, not many people actually fund it that long, but that's how long premiums are payable. So if someone wanted to make a one-time lump sum payment, say it's $1 million, would the minimum premium piece still be due up until the age of 100? The answer would be yes, if I went with a age 100 policy. With that said, so yes, the premium would be due, but I do not have to pay it. So some things to be aware of. Number one is what is called a premium offset. This is an option where my premium is still due, but I can elect to have the dividends and interest, the earnings in the policy, pay my premium first, and then after it's covered, any earnings left over are reinvested into my cash value. So this is a nice option to elect if I do not want to pay the policy and I'm not taking a loan internally to cover it. I don't want to do that all the time. Sometimes it makes sense, but here, premium offset allows the dividends and interest to pay my premium for me. That's option A. Option B is what is referred to as a reduced paid up option. This guy will eliminate the premium altogether. So for instance, if I have a whole life 100 policy that's payable up until age 100, and I elect a reduced paid up option, say at year 10, well, at that point in time, the premium's gone. We eliminate it altogether, so the policy is no longer payable until age 100. Once I elect a reduced paid up option, I cannot add any money into premium or PUA payments. I can borrow and repay all day long, but I cannot add additional dollars. That's with the reduced paid up option. So this is a nice option to maximize the internal rate of return, the reduced paid up, especially when we look at the guaranteed values. However, we do have to be aware of the MEC rules here. So we talk about the MEC limit quite a bit. It has a direct relationship to the death benefit, and the MEC limit is the maximum dollar amount I can pay into a policy each year and still have the IRS view my life insurance policy as life insurance and reap the tax-free benefits, not a modified endowment contract, and then I have to deal with taxation with respect to the gains if I want to access my cash value. So another name for the MEC test is what we refer to as the 7-pay test. The 7-pay test, another name for it, is the 7-pay premium test. It really has to do with the first 7 years of a life insurance policy. How I like to describe this sometimes is the first 7 years is when the vice grips are very tight from the IRS on life insurance policies. And if I drop that death benefit during the first 7 years, often I can trigger a modified endowment contract. My policy will become a MEC. So how I prevent it is often by not reducing the death benefit until year 8. Very easy stuff to follow, right? My point, where I'm going with this, is a reduced paid up option almost every single time will result in a death benefit reduction. So if I were to execute a reduced paid up option, let's say I make a one-time payment and then go reduced paid up year 2, you could do that, but that policy will turn into a MEC almost every single time. Often what I have to do is if I'm going with a one-pay, throw that $1 million in, elect a premium offset years 2 through 7, meaning the policy is going to have to pay for itself years 2, 3, 4, 5, 6, and 7, and then I can execute a reduced paid up in year 8. So that's 6 consecutive years where I'm not paying the premium. It's paying for itself through dividends and also the guaranteed rate. I'll often refer to this as drag on the policy. It's not that efficient, especially if you run a very conservative illustration looking at just the guaranteed values, which we'll look at as we progress through the different videos. So we will look at studies here. I'm going to break that down. What I want to touch on first is another follow-up question we sometimes get, or a point that is hit on is, hey, if I've got a $1 million lump sum and I look at a company like Guardian, who we're going to look at in this example, with a 5.65% dividend interest rate, does that mean if I put $1 million into a policy that I would earn 5.65% on that million right off the bat? The answer would be no. The number one reason is because I have insurance expenses. So I've got the base premium. When we talk about policy design, money can go toward the premium or the PUA component. Just to give a quick example, money can go where? Base premium dollars or PUA dollars, which stands for paid up additions rider. I want to write the word rider out too. Premium dollars do not show up in cash value in the first year. The product we'll look at in this example. So year 1, I don't see that show up in cash value, regardless of what that premium figure is. PUA dollars, you'll see between 92 and 93% show up in the first year, just about all of it year 2, and then it's compounding from that point forward, and you'll see positive growth overall in PUA payments. This is the key to accelerating the cash value growth on a whole life insurance policy. So, with that said, if we throw in $1 million, we will have a premium associated with the policy. The premium piece does not show up in cash value. So that's not showing up in cash value. Also, we're going to have a term rider attached. Using a term rider, it's adding more death benefit to a policy. Why we do that is because it's a cheap way, if you don't like the word cheap, a cost-effective way to raise the death benefit, which gets our MEC limit where we want it. Now, as we go back up, a dividend rate of 5.65%, for example, will not equate to an actual 5.65% growth rate at any point in time. It never will. What I want to look at is the net internal rate of return. That's the terminology we see in the insurance industry. That simply displays the net growth rate. If I've got $1 million in cash value, 4% would be $40,000, or I should put it this way, I've got $1 million in cash value, I see it grow by $40,000, I calculate the growth rate, 4%. I also put the word there eventually. Why we put that word there is because in the first year, you'll see a negative internal rate of return. It'll take a couple of years just to recoup your cash value, get over the initial premium expense and such. So the policy will pick up the pace over time, but I will not see that 4% internal rate of return immediately. The greatest internal rate of return immediately will be on the death benefit because it'll be much higher than the payment. But this individual is laser focused on the cash value. So last thing we want to touch on here is PUA limits and understand or know the rules of the game. So with the paid up additions rider, the example we're going to look at here on this 50-year-old individual is with Guardian. Guardian as a company will allow us to illustrate a maximum of 10x our base premium and PUAs per year. With the exception of the first year, where the first year is 50x. So what that means is with a one-time lump sum of $1 million going into the policy, if this is his plan, how I would maximize this particular example is I know if I have just a one-time payment, because I can't do 50x each year, can't illustrate that, the company won't even let me do it in their software. But if it's just 1 year, literally what we could do here is if I've got $1 million payment, I could set my premium at 2% of that figure, 298 split. It's pretty cool. It's not as good as you would think though, unfortunately. $20,000. We have a couple term riders attached. You'll see the term cost will be right around 10 grand total, and then plow everything else into PUAs. So that would be the one pay. We're going to walk through that. And then the other options, with the 10x, let's say we're going to look at breaking that $1 million up over 4 years as an example, which would come out to $250,000 per year. Well, in this case, what that would look like is the premium would be $25,000 per year. We could actually get a little bit lower, but I just used a clean 10%. So I put 10% of the $250 toward the premium, and then the rest, just about the rest, toward the PUA. We have a term rider in there as well. But what we can't do is have a $20,000 premium, or let's say if it was 2% of 250, let's just say it's two grand for the sake of simplicity, I can only 50x that base premium in the first year. I can't continue to do that. So if we're going to spread the lump sum payment out over a number of years, what I have to do is set the base premium a bit higher. I know this can get deep and complex. Let's look at 2 examples, and then in the next video, we're going to lay out a comparison sheet and go through things very thoroughly. What I want to touch on here is let's just look at this to make things simple. We'll look at those 2 Guardian examples. One with a $1 million payment going in, just a one-time lump sum. And then second, $250,000 for 4 years. And both policies are maximized. So we're going to look at those numbers. Let's have some fun. What we will begin with is a Guardian illustration. Here we go, based on their 2022 dividend interest rate. There it is. Where's the money going? Total payment of $1 million. Here's my premium. 2% of the total payment, maximizing the limits offered by Guardian, where I can 50x the base premium in the first year. So, total of $1 million going in. Got a couple term insurance riders attached. So, we see this RTR. There's the premium, about $7,000. Here's the term insurance rider. We have another term insurance rider attached for another $6.3 million. This is a 1-year term rider, and here's the cost for it. So the total term costs initially are about $10,000, and they do increase each year through policy year 7, which is going to result on an additional drag on the policy. I'll go through exactly what that means as we walk through this. But there's everything else going toward PUAs. Cash-rich policy only in the first year in this example. So let's take a look here I want to walk through that premium offset piece and touch on something that is not really that transparent in this illustration. I would need to run additional reports, but I think this gets complex enough as it is. So here's your net after-tax outlay. This is the actual out-of-pocket by you, the net dollar amount you're paying into the policy, a one-time lump sum, $1 million. Purpose of this exercise is to show you how to maximize efficiency and that this is not the best option, as many people would assume it was. I did before I started to learn the mechanics of this. Million in, year one, when you made that $1 million payment, the breakdown we went through, the premium, term riders, we saw exactly where the money went. Here's your premium. This is the underlying base premium. The term rider costs are not disclosed in here, not in this part of the illustration. So they are being accounted for each year, but we don't see them in this breakdown. We do see the premium here, years 2 through 7. What's your net after-tax outlay? 0. So this individual's objective was what? One-time lump sum payment, $1 million in. I don't want to pay a dime afterwards. So we were able to accomplish that. But I would definitely, or anyone on our team would have a conversation and say, you can absolutely do that. Here's what it looks like, but I might show an additional option, which I'm going to pull up in a second. But during these years, 1 through 7, what we've got here is that premium's due. He's not paying it. Here's his net cash value. First year, just under $900,000. What does not show up in cash value is the base premium, both term riders, and then also the PUA fees that are associated with the product. Now, next year he pays a nothing. The policy is paying for itself. Dividends and interest are covering the base premium and the 2 term riders. Here's a question that comes up. The base premium is $20K. The 2 term riders are more than $10K in the second year. My dividend is only 21 and change. How on earth is the dividend supporting the base premium and the term rider cost, and my value goes up by almost $30,000 in this example? How is that happening? Here's how it's happening. Breaking down illustrations. This dividend column does not reflect the company's dividend rate. You'd think it would, right? Dividend rate would equate to a dividend column, but it does not. The company's dividend rate, and all insurance companies work like this, by the way, is 5.65%. The guaranteed rate with this product is 3%. So the difference between the guarantee of 3 and the total dividend rate of 5.65, if you were to Google search this, Google search Guardian's dividend interest rate, would be what? 5.65%. So the difference, 2.65. The difference, or the surplus piece, is what is reflected in that dividend column. So the guaranteed piece is not. We don't see it on this illustration. We would run an additional report, which we provide all that stuff if you're an agent in our agent training business. But here's the simple answer. Here's your cash value, which is the net cash value growth, net of all expenses, everything covered internally, any guaranteed rate, guaranteed interest and dividends left over. That's what's supporting that growth after it covers the internal expenses. Interesting stuff, right? Here's the last thing I want to touch on in this illustration. Years 1 through 7, this is a premium offset when the premium's due and I'm not paying it. Up here, reduced paid up at the beginning of year 8. That's the earliest we could do it without triggering a modified endowment contract. So, what do you notice here? Year 8, premium is gone. 20K is no longer existent. What do you notice about the cash value growth? Years 6 to 7 was $998, grew by what? About $12,000 to $1,010,000. That means it took 7 years to recoup your cash value. Just about year 6 based on the present dividend interest rate, but year 7. But the main thing I want to touch on, it's about $12,000. Look at the next year. After we hit the kill switch, which is the reduced paid up option, what do you notice? The growth is about $47,000. Much faster. By eliminating the premium, the 2 term riders, we cut the drag. I like to refer to it as throwing the cinder blocks off the boat so we don't sink or we can go faster. But removing the drag does improve the performance. That's common to see with a reduced paid up option, especially when we look at the guarantees. And again, we'll hit that in future videos. So that's the one pay. Why don't we just look at this for now? Year 10, your cash value with the one pay, $1,158,000. If you want to round up, call it 1.16. Now, let's look at the exact same policy, but spreading the payment out over 4 years. So here, exact same policy, exact same dividend interest rate. What do we see here? Breakdown of the policy. There's my premium, $25,000. Total payment, $250,000. We've got a 10/90 split here, 10% premium, only because we can't go with a 2% premium year in and year out. Can only do that the first year. And we have tried many ways to work the system where we can max it in the first year and then still maximize based on the limits years 2 onward. It usually doesn't work just because we have a high premium and MEC limit relative to what we're able to pay in. My point is, this is optimized based on a 4 pay. Actually, we can make this slightly stronger, but you'll see where I'm going here. 4 pay, $250 for 4 years. The individual wanting to get that $1 million lump sum in still accomplishes exactly that. Term rider here, term cost, $1,800 initially. So, when did the last policy break even? Year 7, when you finally surpassed $1 million, and he started off with $1 million. Here, net after-tax outlay, $250 per year for 4 years, same $1 million in the policy. If he's in a position where he says, I don't want to have to log online or send a check in for $250,000 for 4 years, can I just give you the $1 million still? The answer is yes. Insurance companies do offer prepaid accounts, which typically credit between 2 and 3% interest that feeds the policy automatically for you. Pros and cons to those. We've got other content on that. We can provide info if you have questions. But if someone says, I want it hands off, I just want this done for me, insurance companies do accommodate to that. There's strategies you can execute. But there's the payments. On the left, what do you notice? Base premium, $25,000 per year. Here's the key on this. Years 1 through 4, that premium's due and you're paying it. The $250,000 covers the $25,000 base premium. Also, beginning year 2, you see that $25,000, just about all of it, come back to cash value for you. Year 3, all of it comes back to you when we account for dividends and such. You can see that in the net cash value. Year 1, I pay in $250,000. I've got $206 and change, just about $207. Year 2, you pay in $250,000. The base premium is accounted for that. It grows from $206 to $452. So you don't get the full $250 back, just about all of it, but that is a negative internal rate of return that year. However, year 3, you pay it again, you get your $250 back, plus another $5,000. Gets better and better each year, and by year 5, you're at the $1,010,000. Whereas the one pay, it was year 7. So this has actually accelerated the cash value growth. It's interesting, isn't it? Now, we've got the drag on the policy still. Years 5 through 7, premiums due, we're not paying it. Then we execute the reduced paid up option, which is higher up, but that's when you see the premium gone altogether. This is optional. If we put this in an illustration, it does not automatically occur. We actually have to execute that option as the agent when we have a conversation with you when that time comes. He may have changed his mind and said, hey, I want to keep pumping money in. Beginning year 5, this happens sometimes, depending on the individual. But in this example, we're executing the reduced paid up, cutting the term rider as well, and allowing that cash value just to grow over time. Interesting. So by year 10, remember what the last example was? About 1.16. Here, 1.25, 1.25. Same product, same company, same individual, health rating, everything, just funding it in a different manner. So if this individual is interested in using the policy for real estate deals or investing in his business, whatever it might be, he wants the money accessible for that. This is a means to really give him more money. Where it has less money is in the immediate short term, really in the first three years, because you got the full million in the last example. But if he says, hey, I don't need this full million, all of it right away, this makes more sense. This is where he might go with this option. Now, this was a 1-pay versus a 4-pay. If I'm new to this and watching this video, I'm going to have a million questions and I'm going to ask, well, what does it look like if I break that million up over 2 years? What about 3 years? What about 5 years? What about 6 years? I could go on and on to find the most efficient strategy. Well, we did just that. And sometimes I spend too much time doing just that because it's a lot of fun. What we're going to look at in the next video is this exact same case study, 50-year-old individual with $1 million going in, but over 1 year, the same 1-pay we saw, then breaking it up over 2 years, $500K for 2 years, breaking it up over 3 years, that's going to come out to an oddball number of $333,000 and change. And then also over 4 years, we looked at that, and then 5 years. First point will be to maximize the overall cash value growth. You'll see a stronger death benefit with more cash value long-term as well. And then phase 2 will be how to use the money. And we're going to particularly look at cash value collateral loans in this case, as a lot of people are attracted to those right now, but we may slide in some direct policy loans as well. In any event, I hope you enjoyed this video. I always like the technical details. If you did, please hit the like button, subscribe for more. We do appreciate it. And feel free to reach out to us anytime if you'd like to discuss high cash value life insurance. As always, I hope this helps and thank you so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.